Recipes for technical trading success in Cook's Kitchen.
Hey everybody, Cooker here. You know, I don't always do macro, but when I do, I like to have a good reason and bring some good stuff. You know, I prefer to look at industries and stocks and help you find a way to make money this week, this month, the next quarter. But I think it's the time to look at macro. So here's a little thing I did for my Taser subscribers on Monday night. I said, when the market is cheap relative to positive fundamental trends, like it was last year, then I'll look at the macro landscape just for confirmation that those tailwinds are still in place and, you know, we can stay heads down picking stocks. But when the market is expensive relative to largely discounted fundamental trends, like it was in January when I gave you frothy with a chance of complacency, then I also review the macro landscape for confirmation that those trends may have achieved a significant degree of conviction already, meaning stuff's priced in, right? Already discounted, priced in, same concept there. And that makes the market, you know, more vulnerable to wider profit taking. So I've got about 5 macro charts for you from some pretty good leading quants around the world. One of the first ones I showed was from Uri and Timmer at Fidelity, and I'm going to expand this view. I just want to show you his caption. Timmer's caption for this chart was, "The current earnings cycle looks similar to 2010, which was the year after the global financial crisis, after the bottom in mid-2009. So this is, he posted this on Twitter. That was the tweet. And when you look at the chart, you'll get an idea. Yeah, we're having this big snapback, right? Not just in GDP, but in earnings. And that's the good news, really. It is. But I also want to highlight this positive tailwind and this bounce back or snapback, whatever you want to call it, you know, shows up in spending, investment, and EPS growth. But it's well known. Right? It's well known. So how much is it priced in? That's what we're going to try and answer today. How much is all this known goodness priced in? So let's take a look at a bigger snapshot of Uri and Timmer's chart so you can see what's going on here. So the red is 2010. You can see the decline in earnings year over year and the expected snapback. And he's saying, hey, 2021 looks a lot like 2010. In terms of that bounce back in growth. And here's, you know, the drift concept, which is a little more advanced. So net, very good. We just want to know how much of it is priced in. So I'm going to take a couple other views of this here. Let's look at, let's go to BOFA research and quick snapshot here of air travel bouncing back. Kind of what you'd expect, right? It's not going to bounce back completely, right? So there's going to be travel restrictions. Some people don't want to go anywhere. And I just was on a call with my colleague, Brian Bolin, who was looking at planes, trains, and automobiles. And he highlighted, you know, the surge in demand for autos and auto parts and recreational vehicles and boats. He's down in Florida, so he tracks a little bit of this stuff. And you know, boomers selling their house in the north or maybe buying that second home in the Sun Belt and getting the RV, getting the boat. And so air travel may not snap back as much as people expect when the alternative is, hey, stay home and travel, sort of a theme. And then we've seen the snapback in housing too. Just housing's in an incredible bull market, and that one's probably going to last. It's going to be sort of a generational bull market as the millennials settle down. All right, but I want to show you some other stuff from BOFA here. What else did I have from them? Well, let's go to we'll come back to BOFA. I want to show you Goldman Sachs looking at GDP. We've got GDP coming up on Thursday. Goldman is above consensus. I think they're now at 7.7%. This is like 3 days old. I think they just bumped it up again to 7.7%, way above consensus for Q1. and significantly above consensus for Q2. They're calling for 10.5% GDP growth in Q2. And then that's the peak, which you'd kind of expect, right? These, a double-digit GDP number is because we had a double-digit decline this time last year. So, it's the base effect. So how much of this goodness is priced into the stock market at S&P 4,200 and, NASDAQ trying for 14,000? That's the big question. But it's important to pay attention to this. Is this drop off in GDP? Is that recessionary? No, we're probably in a really nice expansion right now for 2-3 more years, especially with the Fed tailwind. We'll talk about the Fed tailwind shortly. But it's something to keep in mind that we're peak GDP is already on the horizon. Okay, who else do we want to talk about here? So I want to find my other BOFA data. Okay, so I'm going to go. Where did I leave that chart? I'm going to slide down here. So this is their economics team. Just in the past week here, raising their EPS forecast. For the S&P 500 to 185 from 165. Yeah, they were kind of late there. And then they launched their 2022 EPS forecast at $205 versus consensus of 203. And when you put an EPS number on the S&P 500 like this, it makes it easy to come up with a market multiple. So what's interesting here is that their year-end target for the S&P 500 remains at 3,800. So you do 3,800 versus 185 or 205. You're looking at them keeping their forward multiple for the S&P under 20 times, close to 19 times, but definitely under 20 times. So even though they're raising EPS forecasts, they think the market is expensive at S&P 4,200. Now, how important is that to hear that from BOFA? Well, they're pretty quant driven, so a lot of funds will pay attention to the number crunching that they do. So that's why that's important. All right. What else I got to show you? Oh, okay. So here's the other BOFA thing I wanted to show you. This is a little more detailed, but this is the longer term forecast where they see the expansion staying in place for a long time. Long road ahead for the expansionary cycle, if history is any guide. I like this stat here in the middle, this top middle chart. Since 1973, from peaks above 60, U.S. ISM manufacturing PMI sustains above 50 for at least a year. So, you get that thrust up to 60 on the PMI, it usually sustains for at least a year. That sort of makes sense. Economic momentum begets economic momentum. And we're seeing it, in all sectors of the economy. So that's the main takeaway there, is that the expansion has legs. It's just wondering, is the market, has it priced in a lot of goodness already? Let's go to Renaissance Macro, another good shop. They just put this out a couple days ago on April 26th. I missed it, but I just found it today. They say this is talking about the Fed, because we've also got a Fed rate decision here, which they're not going to do anything. We know that. But their point is that the Fed doesn't follow other central banks, and the Fed is possibly following a new playbook. Well, not possibly. We know they are, if we're sticking to zero interest rates with this kind of snapback and growth we're having. So the Fed is likely to hold firm. And they say this is not unusual. This is Neil Duda and the economics team there at RenMac. They say we saw a similar dynamic play out early in the last expansion, and it should be dollar negative. So what you're looking at here is here's the Fed funds rate, this gray line straight across here. We went up, we came down, now we're stuck at zero again. Then the actual, so that's the Fed funds target rate. Then this dark line here is the percent of global central banks increasing rates. So that bottom, so you've got central banks slowly starting to bring rates up. But the shadow funds rate, meaning what the market is actually pricing in, what the Fed's going to do, is coming down. So that's, long term, that's fantastic for the economy and stocks. All right. So I showed you Goldman Sachs. I showed you Fidelity. I showed you BOFA. I think I showed you everything I wanted to from BOFA. We looked at Renaissance Macro. So the bottom line is I think that the market is pricing in all this goodness already. Now, that doesn't mean we're going to have another 10% correction, but it means the market is vulnerable to some profit taking at S&P 4200 and up here in the NASDAQ. We'll see what they do with we got big tech earnings this week. But, I'm not a heavy buyer here. I'm interested in taking profits and raising cash, looking for, maybe it's a pause in May and then a rally into the summer. I'm not saying sell in May. I'm saying pause in May and then we rally into summer. And then you think about, August vacations. Maybe we see some bigger profit taking into September. All right. So that's my macro view. We'll talk to you next week.